tips and info. Hello. Hello. Good afternoon. And the Elaine Proby here, PROBY'S Tax and Accounting. You're a tax and financial expert today, guys. And we are back here live on Facebook and on IG, right? And we have some great tips for you guys today. We have been sharing tips on how to stay in business, and now we're sharing tips on how whatever you do financially, how it affects your taxes. So I want to welcome you guys on here on this live video broadcast. Again, Elaine Proby here, CEO, PROBY'S Tax and Accounting. What we have done over the years is assist personal and business folks to maintain their business, for them to grow, for them to leverage, for them to scale. We have encouraged and helped and assist a lot of business people and personal to really acquire assets, which is one of the things we're going to talk about here today. And, just be able to thrive and become more successful personally and business-wise. So that's what we're going to talk about today. All right. So I have some tips, guys, for you regarding investment properties. I have a lot of clients, of course, that are interested in investment properties, some of whom have not bought personal properties before, simply because, when you buy a personal residence, guys, you kind of want to make sure that you know where you want to live because it's a long-term investment. And of course, there are some people, especially some of the younger folks, that are not interested in just being stationary right now. But what they are interested in is how to acquire more wealth. And so they're more interested in buying investment properties. So that's what we want to talk about today. So I'm going to give you guys some tips and then the tax consequences, because everything you do, your taxes are affected. Okay. And so that's what we want to talk about today. So, all right, guys. So let's get into our first point today. All right. Because investment property, again, is a way of accumulating wealth. And, so whether you have a personal resident or not, this is a way of accumulating wealth when you buy investment property. And we want to talk about the cash flow purposes, the tax planning, how you want to plan to acquire investment property, and the cash flow things you need to look for, and how it's going to affect your taxes. Now, one of the things that you got to keep in mind is that when you buy a rental property, guys, there are some tax planning that needs to take place. Just like when we talked about the personal residence, there's some tax planning that needs to take place. You have to make sure that your taxes are filed. One of the things that a lot of lenders are going to look for, simply because an investment property to the lender there, they scrutinize you a lot more. They are really much more, they're much more stronger in terms of how you become qualified. So what you want to do is make sure that you plan ahead, right? Make sure that you watch your spending so your cash flow can be pretty lucrative. Because the way they look at it is you're going to have to be responsible for some of this rent if, in fact, your tenants cannot pay the rent, right? One of the other things that lenders will look for, guys, if you are a majority owner of a business, if you're self-employed or you're a majority owner of a business, if you're a majority owner of a business, what they do is lenders are going to want your tax return from your business as well. Okay, so Before, of course, you buy investment property, guys, before you buy investment property, make sure that you pay attention to what we're going to talk about here today. So I want you guys to make some points, take some notes on this, and get into make some points on what we're talking about. Now, so what happens is the lenders are going to look at your business expense and profit as well. If you are a majority owner, if you're over 25% in any business, they're going to look at the business return. They're going to look at your personal return. So make sure you have your business returns complete. Make sure your personal return is complete. You want to spend less so you have more profit at the end. So what they do, this is what the lenders do to qualify you. They will look at the rental income of the property, right? And if you have never owned any real estate before, they will want to have you be able to pay at least 100% of the rental income, which means that your net income in your business or the monies that you are making personally from work, let's say if you are working, has to be sufficient to cover the mortgage. Okay, if you have not owned any real estate before, this is what the lenders are looking at, because you're more of an at-risk person to them. They want to make sure if you don't have a tenant in that property, you can afford to pay the mortgage. Okay, now if you own real estate, so there's two different things here, and this is important. If you already owned real estate, they'll take the rental income, right, and they'll take 75% of the rental income, and they will give you credit for that. So technically, they are only going to hold you responsible for 25% of the rental income to cover the mortgage. Okay, so listen to this again. If you own any real estate before, what the lender will do is they will look at the rental income and they will take 75% of the rental income. Okay, they'll give you credit for that and say, okay, you only need to make sure you can cover 25% of the mortgage. Now, the other flip side to that is if your rental income can cover the mortgage, right? What the lender will do is, before they give you the loan, what they will do is they will give you additional credit for the amount of money that the rent exceeds what that mortgage is going to be. All right, so it sounds a little complex. The whole idea is this: if you already own rental property, then 75% of your rent, they look at that, they give you credit for that. If you don't own any rental property at all, not even a personal residence, no investment property, they want you to have enough money to be able to pay the entire mortgage, pretending that maybe no one will be in the property, right? So this is the part of the tax planning, guys, that you will have to do in advance. This is point number one, part of the tax planning that you have to do in advance if you are interested in investing in rental property. Okay. All right, so we're going to make 3 points today and give you some tips, and then I'll wind up with the tax benefits, which is always the bright side of everything that we do here, is making sure that you can save money in taxes and how taxes are affecting whatever it is that you do. Okay, so once again, guys, for those of you who just jumped on here, thanks for jumping in. Thanks again, you guys were here too. Thanks for jumping in. Elaine Proby here, CEO of PROBY'S Tax and Accounting, and we're talking today, obviously, before you buy an investment property, you want to listen to this. Okay. All right. So let's get into point number two. Point number two, we want to talk about the property cash flow. Okay. So you have to do some research, of course. You want to do some research. You want to make sure that you're buying a property in an area where the rent is maybe not, there's rent control in certain areas. If you buy a property, okay, with tenants already in there and they're paying a low rent, which is below market. Sometimes you have properties, people have been in there for years and years and years, so the rent is below market. You want to do some research. Make sure that the property, if the people that are in there, your tenants, and it's a commercial property or a rental, a residential rental, that your tenants, if they're in there and their rent is low, you want to take a look at that, because you may not be able to increase that rent because of rent control. So you want to do some research. You want to do some homework on this, right? Make sure you do some homework on this stuff, because your cash flow is going to be super important here so that you can pay the mortgage, right? Now, if you get a property and there is no tenants at all. Now, this is the good part. If you get a property, there's no tenants in there. So now you can charge market rent. And the market rent at that time basically would be able to cover your mortgage. You have to take in consideration the mortgage. You got to take into consideration the property taxes on that property. And you got to make sure that there's insurance covered. These are the things, guys. These are the things that you're going to make sure this is what you got to add up. And then leave some extras for maintenance and other repairs. So you want to add all this up and then determine what the rent is going to be for your investment property. Okay. Let me go back over that one more time. If you have an investment property, there is no tenant at all in that property. For you to be able to charge market rent, for you to be able to calculate what the market rent should be, take the mortgage, take the property taxes, take the insurance. Okay, these are things that you must pay to the lender. And you want to make sure that you leave a cushion in there for repairs and maintenance, because you're always going to have repairs and maintenance. And then you can take that number, okay, divided by 12. You can take that number and determine what your market rent should be for that rental property so you can have a positive cash flow, right? At positive cash flow. So that's what the second point is: evaluating the market, and the property needs to have a positive cash flow. All right. So those are things that you're going to look at. It is said that anywhere between 5 to 8% of is a good rental cash flow. It's a good rental yield. Of course, there's some calculation, like I just mentioned, that you will do there to make sure that you're fully covered. Again, that this is providing you get a rental property and there is no tenants in there. So you're free to charge market value rent. All right. So, all right, guys. So again, like I said, a whole lot of folks is interested in rental properties. Some people who may or may not have gotten their first residence, but they want to invest, they want to acquire wealth. Real estate is a great way to acquire wealth. So a lot of people is interested in doing that. Now they feel like they can get a great deal. And of course, you can accumulate wealth by having a property that will appreciate going forward in the future. And real estate is the best way to accumulate wealth. One of the best ways to accumulate wealth. All right. So guys, let me get into a third benefit. The third part is my most exciting part about it. And this is where the tax benefits, right? The third point I want to make here today is the tax benefit. Now, of course, there is the option of buying a rental property, an investment property, and of course, having it long term and having the wealth build up. But the beauty of the whole thing is the tax effect and the benefit that you will get from the taxes. Now, what happens is, you guys, a rental property is where you could write off your depreciation. Now, I've got that question last week or last time we did the personal residence, and someone asked about depreciation write-off. There's no depreciation write-off on your personal residence. However, on your investment property, you can write off the depreciation. So for those of you who is not familiar with depreciation, what depreciation is you take the property value and you can write off depreciation, which is a passive loss, over a period of years. So if it's a rental property over, like, say, 27 and a half years, you get to write off part of the value of that property as a deduction. It's only a paper deduction on your tax return. It's not cash that you put out of pocket. It's a paper deduction on your tax return. So for the value of the property, you get to write off a portion of that over 27 and a half years on a residential rental property. That is the depreciated value, and you write it off over the years, and it's a paper deduction. So once again, you're not putting any money out. You get this paper deduction. It will reduce your rental income, right? It will reduce your rental income. So if your rent is $60,000 for the year, you're not paying taxes on the $60,000. You get to write off your depreciation. You get to write off other expenses on the property. Okay, so you get to write off all this. And then the bottom line is what you pay taxes on, guys. The best deduction is the depreciation because that's not money out of pocket. So that's the best deduction. A lot of investors, they buy investment property so they can take advantage of the depreciation, right? The advantage of the depreciation. And you pay a lot less taxes because your net income is less. As a matter of fact, if you make less than $100,000, you can write up to $25,000 worth of rental loss, including your depreciation, up to $25,000. And that will offset any other income that you have. So it will save you a lot of taxes, guys. Okay. So the key here, the tax benefit, which is usually my favorite part, tax benefits of buying investment property. Outside of it being a long-term investment, outside of you accumulating an asset that's going to appreciate in the future, you got this tax benefits over term. All right. So today, Thursday, of course, this is a Q&A. Elaine Proby, CEO, PROBY'S Tax and Accounting. Again, here, your tax and financial expert. We are doing business here in LA for over 35 years. We help a lot of individuals and businesses succeed. We've helped them to grow their business and, of course, save on their taxes, guys. We have done that over the years, and this is the reason why we're doing these free consultations so that you guys can pick up some points, some tips that will help you in your personal and your business lives. And I have a couple of questions over here. Beautiful watching. Hi, Bernetta. Here we go. Can I buy real estate through my business? Okay, so the question over here, can you buy real estate through your business? Now, yes, guys, business can buy real estate. Of course, there's got to be a credit that is, the business has to have good credit, because then a lot of the lenders are going to lend you money based on your credit status. So what you want to do once you acquire your business, guys, for all the people out there business, once you acquire your new business, what you want to do is establish business credit, right? Establish business credit. And so once you establish business credit, yes, you can buy a property or you can buy real estate through your business. Your business will be qualified to get a loan from a bank and buy real estate. A lot of businesses are the ones that are actually buying property once you get established. Okay. Yeah, so that's a good question. Good question. Can I write off home improvement on my taxes, like upgrading the bathroom, kitchen, or curb appeal? Okay, so if it is your personal residence, guys, you cannot write it off. Okay, if it's a personal residence. Now, there's a little trick right now, because if you have an office at home, a lot of people is working from home. If you have a business at home, right, now you got your home office business deduction. Now, if you are doing business from your home, that question there works, because a portion of what you put in to improve, what you put in there to improve your home, let's see, upgrades and all that stuff, anything that will reflect the way your office is functioning while at home, guys, there's a percentage based on your home office percent. That is a percent of that expense that you can write off against your business. Yes, of course you can. All right, so that's a very good question. Very good question. All right, guys, so if you have any other questions, again, you know what, make sure you put it here on the screen. I will come back through here and answer those questions. I want to welcome you guys here once again. PROBY'S Tax and Accounting. We're here to assist you in all your tax and financial needs, guys, right here at PROBY'S Tax and Accounting. Again, you can give us a call here at 323-290-9034 and or visit our website at probystax.com. We'll be happy to help you. Like I said, we specialize in taxes, accounting, business consultation. Okay, so what we do here also is we set up businesses back to the real estate. There's a lot of people who create separate entities to house their real estate investment. So you may want to form an LLC to put your real estate investment in. I have a lot of clients who have a lot of properties. They create different LLC and put different properties in the LLC. It definitely helps you with the tax write-off, guys. It helps you with the tax write-off, especially if you have a separate entity and your real estate investment property is in that separate entity, right? And we can get into that in more details again, because there's a limitation of what you can write off in your personal tax return. But setting up your investment real estate property in separate entities, different LLCs, give you more of a tax benefit. You guys, we can get into that one later. We'll have another session on that. But today it's just a matter of, before you invest in rental properties, guys, I want you guys to go back over this video if you haven't made enough notes. And there's some good points and some more, obviously, that you can get. We can discuss that a little bit further if you give us a call here at PROBY'S Tax and Accounting. All right. So I think with that said, guys, I want to thank all of you guys for joining in. We are here every Thursday afternoon updating you with more tax and financial tips on, one, how to stay in business, and two, personally, how you guys can stay afloat, how you can keep your finances going, and of course, how to build some wealth and, for the future, because that's what we're all looking forward to. Okay. So I want to thank you guys for jumping on. Hello, Tuco. Hello. Hi, Vanessa. Hi, Therese. Hey. We could talk about on Tuesday. We'll be back here Tuesday at 1 o'clock, you guys, and have a blessed Thursday. And I'll see you guys back here later. Take care of yourself. Take care of each other. And we'll see you guys back here on Thursday. Bye-bye.